Can lower geopolitical tension actually boost your portfolio? Today's rally across Asia hints the answer is yes, and the why matters for your next moves. Markets opened stronger with South Korea's Kospi hitting a fresh record. Investors are reacting to signs of progress in U.S. Iran talks. That matters because de-escalation can cool oil risk, stabilize inflation, and make interest rate paths more predictable. When headline risk eases, earnings visibility improves, and valuations can hold up better. The strength was broad, not just a Korea story. Japan's Nikkei, Hong Kong's Seng, and India's Sensex all pushed higher. When several major benchmarks move together, it often signals a shift in risk appetite, not a one-off local driver. That breadth can mark the start of a more durable tone if the macro backdrop stays supportive. The key link is energy. Lower odds of supply disruptions reduce the energy risk premium. That can soften oil volatility and take pressure off headline inflation. With central banks still focused on getting inflation near 2%, fewer oil shocks mean less need to tighten further and fewer delays to any eventual easing. A steadier rate outlook cuts financing uncertainty for companies and improves how analysts model margins. Earnings optics brighten when input costs are less jumpy. Analysts can refine revenue and margin assumptions heading into mid-year updates. Cleaner comparisons help the market reward operational execution instead of reacting to noise. What does this imply for positioning? Quality cyclicals and exporters look better if energy stabilizes and global demand holds. That favors Korean exporters and Japanese manufacturers with operating leverage. Banks benefit from clearer rate paths and manageable credit costs, especially if policy rates stay elevated for a while before normalizing. In credit, calmer oil supports high-yield spreads in energy-sensitive names, though balance sheet risks still matter. For investment grade, moderating inflation risk can revive demand for duration from investors seeking carry with less drawdown risk. If you use ETFs, broad regional funds with heavier Korea and Japan weights may capture the initial sentiment upside. Your practical takeaway: watch the trio of oil prices, inflation expectations, and rate futures. If oil volatility continues to cool, consider tilting toward high-quality cyclicals, export leaders, and strong banks. Reassess duration in investment-grade bonds if inflation risk moderates. Use broad beta ETFs to express the view and keep risk controls in place in case geopolitics re-escalate. Want the deeper breakdown and sector details? Read the full article at finlitica.com.